Welcome back to Am I Catching a Falling Knife? The podcast where we cut through the noise to figure out if that stock plummeting down is a dangerous trap or a potential bargain. I'm your host, Dave, and today we're shining a spotlight on a company that's seen a significant dip recently, ON Semiconductor, or simply ON. With a drop of over 20% in the last few days, this ticker is definitely flashing red on the charts, making us ask the quintessential question, is ON a falling knife we should avoid, or is there an opportunity lurking beneath the surface? The current market narrative is all about disappointing Q2 2025 earnings. We're talking a year-over-year revenue decline and an EPS miss. Even though they slightly beat on overall revenue and have a strategic focus on long-term growth areas like AI and automotive, the market reacted negatively to the overall performance, especially in what's already a challenging semiconductor environment. So, what exactly is ON Semi, or ON Semiconductor? They're a leading American semiconductor supplier, primarily focused on intelligent power and intelligent sensing solutions. Think about where these chips go: the automotive market with vehicle electrification and safety, and the industrial sector, powering sustainable energy grids and industrial automation. Their product portfolio is pretty diverse, covering power and signal management, logic, and custom devices. Digging into their revenue, nearly 45% comes from their Power Solutions Group, another 39% from Analog and Mixed Signal Group, and about 16% from Intelligent Sensing. Geographically, they've got a global footprint, with significant revenue streams from places like Hong Kong, Singapore, and the UK, alongside the US. Financially, they pulled in $6.665 billion in annual revenue, had a $3.64 billion free cash flow, and carry about $3.37 billion in total debt. Their gross margin is respectable at around 39.85%. Now, about the impact of those earnings. Our analysis estimates a significant negative impact on their upcoming quarterly earnings, around 17% lower than prior expectations, with a confidence interval ranging from an 11% to 23% decline. Why do we think that? Well, let's break it down. First, the market narrative explicitly points to disappointing Q2 2025 earnings, a year-over-year revenue decline, and an EPS miss. That's a clear signal of negative trends in their profitability. Second, that negative market reaction, combined with the ongoing challenging semiconductor environment, tells us that investor expectations for ON's future quarters have definitely been lowered. Third, given that ON's core revenue comes from segments like Power Solutions and Analog and Mixed Signal Group, a broad, challenging semiconductor environment is going to hit these areas directly, putting pressure on both revenue and earnings. And finally, an EPS miss and a revenue decline tend to have an amplified negative impact on net earnings, especially when you consider their operating leverage and that solid 39.85% gross margin. Because the narrative used qualitative words like disappointing and challenging without hard numbers on the exact revenue decline or EPS miss, there's some inherent uncertainty, which is why we give that confidence range. So, if the earnings outlook is challenging, what's a stock actually worth? To figure out what this stock is really worth, I'm looking at it from two angles, using data I pulled from finviz.com. First, a discounted cash flow, or DCF model. This model projects future cash flows and discounts them back to today's value. Our assumptions for ON here include a growth rate of about 2.3%, a discount rate of 9.5%, and a long-term terminal growth rate of 2.5%. Based on our base case, before factoring in the recent news, the DCF gave us a value of around $15.52 per share. But when we apply the negative impact of this recent news and the lowered earnings expectations, that DCF value drops to approximately $11.95 per share. The second method is a bit simpler, a PEG-based valuation. PEG stands for price over earnings to growth, and it's a quick way to gauge if a stock's price is reasonable relative to its earnings growth. This method gives us a fair value of about $3.66 per share. Now, with the stock currently trading around $47.97, you can see these valuation methods are pointing to significantly lower intrinsic values. Given this deep dive into ON and the estimated impact on future earnings, what are some potential levels where this falling knife might become interesting? Based on these models and market context, we're looking at potential buy levels at $32, then $25, and a deeper value level at $15. These are the points where the risk-reward profile might start to look more compelling if you're comfortable catching a falling knife. All right, that wraps up our deep dive into ON Semiconductor. Remember, folks, this is not financial advice. Always do your own thorough research, consult with a financial advisor, and understand the risks before making any investment decisions. Thanks for tuning in to Am I Catching a Falling Knife? I'm Dave, and I'll catch you next time.